KB Homes beat expectations for Q4, but revenue and profit were lower from a year ago. Our next guest, however, says the company does stand to gain some outsized share going forward, remains optimistic about the builders. UBS analyst John Lavollo is here at Post 9 talk about the sector at whole. It's good to have you, John. Welcome.
Thanks, Carl.
Is it about selling price? Is that why we're seeing what we're seeing this morning?
Look, I think that KPIs across the board for KBH were above expectations, frankly. The one area that was a little bit soft with orders, now they were up 176% year over year, so not too soft, but a little bit below expectations. Keep in mind, interest rates or mortgage rates went up over 8% during the quarter, right? So because of this, KBH slightly trimmed their top line forecast for the year. I think the market's sort of digesting that today.
You make an interesting point about sort of this lock-in effect that we're seeing regarding rates, and how we kind of saw it in the Volcker era. Is that right? How did it play out then versus how you think it's going to play out now?
You know, interestingly, new home sales are recovering faster this time around than we did during the Volcker years. And really, it's a function of the home builders being very creative in their financing offerings. So they're offering mortgage rate buydowns and things of that nature, which is really sort of smoothing out demand and bringing a lot of people to the table that perhaps would have been challenged from an affordability standpoint.
Well, one of the biggest surprises is that they spent much of last year, while the Fed was raising rates and mortgage rates were shooting higher, going up the stocks because of this inventory problem. So is it harder to pinpoint the right valuation now that activity and rates are coming down and activity is going up, because that backdrop is one of strength?
It's a great question. And look, I think that there's a very compelling argument to be made here that these stocks are way too cheap to the market. They're about 13 turns cheap to the S&P. Think about it. Balance sheets have improved significantly. There's an opportunity for outsized market share gains. Margins and returns are structurally higher going forward than they were in the past. And I think that the opportunity for consistent cash flow throughout a cycle is something that we're going to see. These stocks are very different than they were in the past, and very different companies, frankly.
Are you expecting existing supply to come online this year to surprise either up or down?
It's the big question. We're modeling officially existing home sales increasing about 5% year over year. I think it's important to keep in mind that 80% of mortgages are struck at 5% or below, 60% or 4% or below. So I think we would need to see a pretty meaningful pullback in rates to see a glut of supply come back. And unless this supply coming back to the market is unruly, if there's something that happens in the economy that causes a disruptive flow, I think it's fine. The market right now is dysfunctional. We need this supply to come back.
What's your year-end forecast for, say, the 30-year fixed? Has it have a 6?
You know, look, I mean, that's above my pay grade.
Yeah.
However, what I would tell you is our forecasts are saying, look, we're going to keep rates about where they are today. We're a little bit more conservative than the street on margins because of that. If we do see rates come down, which everyone seems to be thinking is going to happen, and I hope it happens, there's going to be upside to our numbers and to street numbers.